about one of the aspects that Greg was mentioning. So we will be talking about financial inclusion and financial education and how they lead to each other. So at the ILO, we really think that financial inclusion, people having access to financial services, everyone having access to all the services you and I have access to, is really one of the building blocks towards being able to access economic opportunities, to create employment, create jobs, improve your own job, access education. So protect yourself from risks, mitigate income shocks, and many, many more things. So when we work or when we talk about financial inclusion, we look at it from two aspects. The aspect of the supply, so the financial service providers, the banks, the financial cooperatives, the payment services, all of those financial service providers that provide the services, but we look at it as well from the clients, the beneficiaries of those services, us. So the work we do and what is interesting to look at is how, as Greg was mentioning, how can we make these financial service providers help us to achieve those social outcomes. Some of the activities and some of the things we do and the projects and that we do is to work with the financial service providers to be client-centric and to answer and to come up with products and services that are answering the needs of those clients and those beneficiaries. But at the same time, those beneficiaries as well, what we have seen in many instances, either they have a fear of accessing financial services because they are not used to, because they have had a bad experience, because they have not been welcomed in a branch of a bank, or because just they don't know, because they have not been really in their education or they have not been exposed to this. And this is what we do through financial education and financial literacy. So when we were talking, I mean, I realized I am with mathematicians here. And so when I said financial education, I was told you probably need to define it, because for the crowd that will be listening today, it will be, but this is what we do. These are our study, financial mathematics. So actually financial education is the transfer of tools, knowledge, capacities to help us manage better our own finances, our personal and our family and finances, to achieve or to be able to take better financial decisions. And the outcome of it is what you probably perhaps have heard about, is the financial health of the financial well-being. To be at ease and to manage well and to be in control of your finances all over. So I am really, really happy to be joined today by two panelists. So I will start by, so I have with me here Karen Bennett, who is the Chief Executive Officer of Enterprise Credit Union from Liverpool. Right? And joining us from far, from Cambodia, hello, Porhour Ly, who is the Senior Product Manager of Boost Capital. So I would like them to present themselves. They will do better justice to themselves and to the enterprises that they are working in. So let me first give the floor to Karen and ask you to explain about the Enterprise Credit Union and what is your business, who are your primary clients, what are your main products, and so on and so forth.
Okay, so hi everyone, and thank you for the invite. If I may, I mean, as I was introduced, my name is Karen Bennett. I'm the CEO of Enterprise Credit Union. I hope I don't speak too quickly. I am known for it. Hopefully you can understand me. But may I begin by just maybe expanding slightly on what Craig was saying, and I disagreed about the finance sector, because I'm very biased. I work and I'm very passionate about the community finance sector, in particular credit unions, and I'm an international advocate as well, I'm glad to say. But just for a stat on community finance and credit unions, there are 291 million people who are members of credit unions in over 118 countries. And so the World Council for Credit Unions are the biggest ambassadors, trying to make sure that we have a voice, a level playing field with researchers and the corporate banking sector as a whole. So that's across the world. In the UK, there are less than 2 million people in the credit unions and less than 150 actual credit unions. So as you can see, we are small players in a big pond, if you like, but we have a massive impact. And I think all credit unions are very, very focused on that social impact and making sure we're a cooperative and we're only there for our members. We are not there for the corporate profit, if you like. And as a cooperative, all of the surplus goes back to the members. So as it began, yes, I'm CEO of Enterprise Credit Union. I have been for 25 years now. I began when I was about 14. But seriously, I've been now, I run the most successful community credit union in this country, something I'm very proud of. We have 24,000 members in our credit union, and we have assets of £44 million. We are based in one of the most deprived communities in Merseyside. It's called Knowsley. I don't know if anyone knows that. It's in Huyton, and we have branches across Merseyside. So we offer savings and loans to anyone and everyone in the community. We offer people services who are financially excluded. We offer corporate membership, and we offer savers as well. I don't know whether anyone knows what a credit union is, but in my very basic terms, it's just a financial cooperative. People save together, and from those savings, and they are only saving from individuals, from that money, which we've got just on £40 million worth of savings, we lend that money out to each other. We offer the lowest interest rates possible, but at the same time as well, we are, as Craig said earlier, we are governed exactly the same way as a bank or a building society. So we sort of have those restrictions on what we can do. You know, we are sort of responsible to the regulators and ensuring that every pound that's invested in our credit union is solvent, and we're offering, you know, sort of a good, sustainable service to those people. Is that okay? Or do you want me to say a bit more about that?
Perfect. No, thank you. Perfect. Thank you, Karen. Porhour, the floor is yours to tell us about Boost Capital.
Sure. If I may, maybe it's also helpful to share some visual slide as well, because I know I'm talking visually, so just to engage the audience. Let me know if you can see the screen sharing.
We can, not anymore.
Yeah, okay, give me a second.
Okay, you stopped apparently.
Yes. Can you see the screen share now?
Yes, and if you can expand, if you can click on share mode.
Yes. Is it better now?
Yes, thank you.
Okay, thanks. Hello everyone, thanks for having me. My name is Porhour, so I'm the Senior Product Manager at Boost Capital. So at Boost, we are a SaaS company, so software as a service. So in a way, we are a fintech company. We do financial education as well as financial service onboarding through chat. So with us, customer don't have to download any app. They can apply for a loan, saving account, insurance, and also consume financial education 100% through chat. So they mainly apply through chat. They also do they also upload required documents as well as doing the full eKYC process through chat. We are an award-winning SaaS company. We have investors ranging from SOSV to Institute and also Village Global. We are currently operating in multiple countries across Asia, from Singapore, Cambodia, which I am right now, the Philippines, India, and also we are growing in Southeast Asia region as well. So again, in terms of our services, we offer loan onboarding, deposit onboarding, merchant onboarding, insurance onboarding, as well as financial education, all through chat. So you're thinking about the familiar messaging platform that customers are already using. So ranging from Facebook Messenger to Telegram, WhatsApp, and whatnot. So in terms of the customer experience, customer chat through the chatbot, and we do the whole process end-to-end via chat. So in addition to our main business, which is the financial service onboarding, we also focus on financial service as well, seeing that we're at the nexus that enable us to connect financial service provider with customer as well as the financial education provider, because we are B2B2C, meaning we interact directly with the banks as well as the customer. So with the financial education, we educate the learner through chatbot as well. One of the projects we are working as well right now is actually with ILO in Cambodia, with the Better Factory Cambodia. So the project is to educate the learner to be a bit more financially savvy, so that they can be more aware of their spending, having not overspend, and also not contributing to over-indebtedness. At the end of the lesson, the learner also get a certificate that they can then share to our bank partner, either to onboard for a saving account or a loan account, which I think we can discuss later during the panel.
Thank you very
for a quick introduction. Yeah.
Thank you, Porhour. Thank you so much. So as you can see, we have what we call a fintech. So, and I like your definition of saying that you are at the nexus of financial services and financial education, providing digitally financial services through partner banks, but also providing financial education at the same time. And we have a brick and mortar, community engaged and rooted financial institution that is really in the day-to-day interactions with the communities and with their needs. So one, as I understood it, of the purposes of the Enterprise Credit Union is to help your members in their day-to-day finances, in mitigating income shocks, paying their bills, advancing their expenses for the holidays, for the kids going back to school. So basically smooth their consumption and face the day-to-day expenses. So while this is really important in reducing vulnerability, what we have seen in other contexts is that this might increase or might, expose them to the risk, expose the members or the clients to the risk of over-indebtedness. But in our preparatory discussions in the panel, I understood that you were also very worried and very careful about this, and that in your suite of services, you don't only offer financial or loans, or not only one financial service, but what's the approach and what other services do you provide?
Okay, thank you. I'd say we offer a holistic approach. So certainly we do offer the loans products. Every member in the credit union is encouraged to save. I mean, we have members who are saving £1 a week, £2 per week, whether they need to borrow or not. And the whole ethos around that is to build up their own financial resilience for those life shocks that they have. And they're accessible, those savings, whenever they need them. That's a big thing. I think sort of, you're right, the big banks and other organisations would sort of turn people away who wanted to save small amounts, whereas we don't. We know our customers, we know our members, and we know that there's members out there who, you know, treat them exactly the same, but they can't afford to save for the holidays that we like to go on. They can't afford to save for Christmas and so on and so forth. I'd say around about 70% of my members would be young mothers in that community, you know, who want to save, who want to build up money, you know, sort of for the kids, but also need access to credit, you know, because no matter what, you know, so you've got a couple of children, you know, when your washing machine goes, they need some help and support there. So I'd say they're two elements of what we do. In addition to that, we do have a support hub that was mentioned earlier, that's our digital offering, if you like. That is a support hub, where people can go in. It's, it's a chat environment where people can share some of the issues they've got, and we will work with them to budget, to sort of look for best deals and so on and so forth. So I think, with the credit union, I think we do try and provide that holistic approach. Certainly, I know insurance was mentioned there. That's a big barrier for people who are in financially excluded circumstances to access insurance. So, I'm proud to say that we offer insurance to our members, life insurance, and we're just about to roll out the suite of house insurance, car insurance, etc. So I think offering the whole service is key. And I think sort of, you're right, we're a bricks and mortar organisation, and we're proud of that. But we're not silly enough to know that, this day and age, not everyone wants bricks and mortar. So we're trying to get that balance with the online presence, along with if someone needs us. We're trying to get the people out the queue who don't want to be in the queue, and they can self-serve. But certainly coming in to speak to us on a face-to-face basis does help. Also, sort of captures anyone who's digitally excluded. You're not just financially excluded. There's people, all around us who would be digitally excluded as well. So we're trying to find that balance, if you like, and we're doing quite well with that. So, yeah.
So perhaps let me ask you, you were mentioning about the hub.
Yeah.
So in your holistic approach, you are providing different financial services, but at the same time, you are providing these non-financial services through the hub and through what I understand as being some financial education. So, no?
No, absolutely.
Okay. So what do you have you seen a difference between your members that are having access to those non-financial services, to this financial education, and the ones who are not, in terms of financial behavior, in terms of repayment, perhaps better savings, more regular savings? Have you seen a difference between both groups?
I've just done some stats this morning. Since November 23, over 9,000 people have accessed our hub. So they've gone on, maybe, everyone might be to look at sort of what's the tip of the day, or certainly looking at budget and so on and so forth. In honesty, I mean, we don't have the resources to say, well, of them 9,000 people, they're saving more, or so on and so forth. One thing I would underpin with that, though, we are very, very open to discuss anything with our members. We have the lowest bad debt from credit union perspective in the country. So people don't default with us, people, and that's not because we have big, heavy debt collectors. People, we work with our members, it's not just that hub they have, it's working with what they can afford to save, to borrow, and to repay. So it's all part of that package, if you like. So
the social aspect and the closeness also to your members, you think?
Yes, yeah.
Thank you. So Porhour, let me go back to you. And so for Boost Capital, what I really find amazing in your work is your hypothesis that you link, or you think that providing capacity building, providing financial education to entrepreneurs in Cambodia would make them a better credit risk and would reduce their risk vis-a-vis financial institutions. So not only you think this, but you have also implemented it and measured it, right? Can you tell us a little bit more about the process, but also the experience and the research?
Okay, as mentioned earlier in the introduction, right, what we do at Boost is we work to onboard customer for the financial institution, but we also are at the interface with customer as well. So leveraging our unique position, we then try to answer this question that I think everyone kind of assume, but also don't have data to back it up, is whether people who consume financial education, are they better financial customer? So a while ago, we have a project with MasterCard Stripe to try to understand, is there a link between financial education and loan repayment? Because with our financial institution clients, we mainly work on loan as well. So just to give you a bit of background on how we integrate financial education with the loan onboarding process. So we try out different touch points to see which one have the higher uptake when it comes to financial education. So we first do it at the onboarding stage. So we introduce financial education as part of the initial engagement when the customers say, okay, they want to start borrowing. There's a lot of benefit in engage them early so that they have better financial literacy and also have they are more prepared for loan applications. What we learned though is that timeliness to have customer engage in financial education is very important, and to tell customer who are applying for a loan that they should instead like consume financial education was not a good idea at all. So the uptake was very low. We then look at other touch points such as post-rejection. So this is also a mean to manage customer expectation as well. So customer could be rejected for loan for multiple reasons. Sometimes they get rejected for loan because they have too many existing loans, or they don't have enough income to then repay back the loan. For each cases, we then tailor the financial education based on the rejection reason. So the customer know that if they take the financial education, it could also improve their chance of getting future loans. So that's we see a great uptake. The last engagement is at the post-approval stage. So when the customer got the loan, we also use financial education as a ongoing customer support as well as customer engagement tool as well. So the tools last point, we really see a great uptake from the customer. Now back to the question whether what the research show us is that we can see that if you look back at the customer experience I just shown you earlier, after the customer learn the financial education, they then get a certificate which they can then share with our bank partner for loan. So we have both the data of them taking the financial education as well as their data from the credit bureau when they choose to apply for a loan. So when we look at the cohort of customers who study financial education versus the general population who apply for loan in general, we see that the cohort that consume financial education generally have a good repayment rate compared to those who do not consume financial education. Now, this is mainly look at the historical repayment data based on the credit bureau data. So through the 9 months that we work with Strive community, we reach over 4 million impressions and over 131,000 data points. And among them, 5,600 of them were mainly business education, which reached the MSME population. So the data really shown a strong correlation between people who consume financial education and then repay back the loan.
So you were mentioning, Porhour, that you are basing your analysis on past data, historical data from the credit bureau. Does it mean that by default you are seeing that the clients or the people that have better repayment rates are the ones that are mostly attracted to financial education? Is this what you are saying? Or are you seeing that because they, okay, it's correlation, not causality, but so you see that people that are in the financial education space taking your classes, financial education or enterprises, business enterprise development, they are the ones that have better repayment rates. Is it historic or is it linked to the training?
We cannot say for sure that it's a causation, but we know there's a correlation there. So instead of saying that these are the people who have the means to pay, and so like if you look at the credit assessment perspective, but we are saying these are generally the people who have the willingness to pay.
Okay. And if I can ask you, how did you collect the data? Because you might know that I have in front of me a lot of mathematicians here, and for them, data is gold, and they want to know how pure is that gold. So how did you collect the data?
So we have the advantage of our platform being digital. So every touch point is traceable and measurable. So we can see where the learner coming from, what were the reason they were rejected for loan in the first place, and also because we work with financial institution to also assess loan and onboard loan, we also see the data from the credit bureau of that cohort as well.
Perfect. Thank you very much. Very interesting. And it's interesting, yeah, to see definitely this correlation between non-financial services and better repayment in general, because this is something, yeah, many, including us, we struggle with. So Karen, let me go back to you. So you see that, yeah, Boost Capital and are providing this financial and non-financial services, mostly to entrepreneurs, but at your credit union, you have a program called See You at Work.
Yeah, that's correct. So we work with a number of employers across Merseyside, and we offer payroll services to those employees where a deduction at source is taken for savings or loan payments, etc. So we go in once a month to a number of our employees with my team, not me, my team go in, and they have sessions for the employees just to go in, have a one-to-one, some counselling, maybe some money guidance. And we work with our employees, but not only them, like sort of the employees, we do that in the community as well. So where people meet, we tend to go in, and so we have a team of 3 who go through on a rolling calendar, you know, per week, per month, going across, you know, yeah, our community there. So
and what
it's really well received, I should say. Can I just pick up on a point as well, regarding the data? And fantastic to see what Boost Capital is doing, you know, but what we're finding, certainly in the younger generation, there's not so much people, there's no data behind the credit. So you're looking at people with very thin credit files, you know, so it could be someone only just with one mobile phone, or you know, just left school, come to uni, come to a new country, you know, and the barriers there are quite evident for those people. And those, you know, that's what we're trying to achieve, working with students where, you know, just as the plug, you know, we are open to any student who studies in Merseyside, but finding working with those students and young people do not have that credit file, you know, and that data behind them. And how do we build with those people to try and help them? And that's the big education piece, you know, to try and say, well, okay, then it could be a credit builder loan, you know, small loan to build up your credit, you know, so on and so forth. And I think that's key. We mustn't forget about those thin credit files either. So
you also help your members to also build the credit history.
100%, every member. We work with every member, you know, and some of them are coming in with really low scores, you know, because we know the member, we would more than likely approve a small loan to let them build up, you know, but we will tell them the score, we will get clear score with them, you know, and say to them, okay, this is your score, these are areas you could improve on. And you'd be amazed at, you know, the lack of education out there, that people don't realise what happens if they, you know, let a mobile contract, you know, sort of lapse, if you like, and so on and so forth. You'd be amazed how many people are not savvy enough to realise that. And the danger, you know, sort of what happens, you know, in a couple of years' time when they're looking for a mortgage or a car, you know, and, you know, working with them now with those thin files, you know, it can only help the economy as a whole, can't it? So.
Yeah. And those interactions, they happen when the members come to the credit union, or do you go to them, or does it happen digitally, or how is the?
Well, as I say, it's a holistic approach there. So every one of our members has a review once a year, or invited in to a review with one of my team, you know, so we're working to make that more digital to our CU chatbot, if you like. But every member has an opportunity to do a review on their accounts, see what to do, and see what to think about the next 12 months, and just working with them in that. It's building that relationship with them. So hence the low bad debt. Hence it's sort of, we say we get a member, they come through, and we do end up with generations of those members. So yeah, it's working. I just wish we could scale it up, to be honest, but I know that's a question coming later on. So
okay, so let me go back to Porhour. So as you know, I mean, and you mentioned it, you were working with the ILO, you are collaborating with the ILO, but we have an international program on financial education. And one of the questions that we are still having, we have anecdotal evidence for, but we don't have hard data to back it. And that is classroom training is more impactful than these digital interactions. But of course, nothing is perfect, but it also comes with less outreach, it is costlier. So I wanted to ask you, from your experience and from what you are seeing in terms of impact of financial education on the change of behavior and the change of attitudes of the persons who go through your training, your chatbot, and these interactions that you mentioned are also in certain points in time. You have different touch points. I know from the discussion as well that you have notifications to kind of bring people back to the training, and also you have the possibility to push messages or to push notifications where they are or at the verge of doing a financial transaction. So how do you see from your point of view this difference or this impact between classroom training and digital training?
So definitely what we are doing here at Boost is more digital and chat-based. But we understand and also cannot dismiss the advantage of traditional in-person financial services, whether it's education or it's like applying for a loan or a saving account, because definitely in-person financial service offer more personalized interaction, and from like face-to-face meeting, you're able to build more customer loyalty and also provide tailored assistance because of the interaction real time that you have with the person you are talking to. So generally, when we design our digital offering, especially with our chatbot, is we want to retain all these best elements from the traditional service, right? By ensuring that the chatbot is conversational, it is interactive, personalized, and also relevant. So to keep the the learner or the customer engaged in the conversation. We also try to make sure that whatever we are delivering, especially the content, need to be very bite-sized. Because we learned pretty early on that if we just push in long content form or like long video content, it wouldn't work because it's just a one-way conversation. So we try to make it very bite-sized, very engaging, so the learner can also like answer different questions and really engage along the way. So another advantage of like doing digital learning is the fact that it's traceable and also measurable. So we can like measure all the progress, engagement, and also continuously improve our content or technology accordingly. But of course, there's still a lot of merits with the physical training. Especially when the content is very complicated. So normally what we like to do is to blend digital with the physical training. And this is also what we're working on as well with the ILO Better Factory Cambodia project, where we are now chatbotifying their lessons, especially regarding weight calculations. So there's a lot of like different situational contexts going that the chatbot may not be able to provide right away. So for subject matter that is complicated like this, the best way to go about it is to have a blend of digital and physical training. So you might imagine that the learner can start the learning experience with the chatbot, and then they can go to an in-person training to better clarify and also get detail on certain points that they don't get or need clarification on. But at the same time, after that, they can revisit the learning and also do quizzes through the chatbot to really solidify their learning. So I think a blend would be a good way.
It's interesting that you started from the digital and then you realized that the human interaction is important, and you started from the human interaction and then realized that also for the convenience and
it's finding that balance, and sort of being at the fingertips of people. If they need just sort of just to dip in and see something, that's great, but they want to speak to someone who's having that. As I say, accessibility is key.
But also what is interesting as well, and as you mentioned, Porhour, from the digital training or the digital interaction, that you can create data. And you are close to these folks, so don't use them in case you have...
If anyone wants to volunteer and come and help us with data, I'd be absolutely delighted. So yeah, I mean, as I say, we're not experts in the data. We're certainly not mathematicians in that respect. But we do have a massive amount of data there. I was just thinking then, there's so many opportunities that we don't capture. We don't capture that rich data. But over the years, I can give you numbers. We've lent out over £200 million. We've helped over sort of 30,000 families, and really have educated those families and turned them from, in many cases, financially excluded to just being savers now, and they've got their kids to join and so on and so forth. So capturing that would be wonderful. We do social impact reports, and stuff like that, and annual member surveys, but the raw data, as in 9,000 people have, gone on to our See You at Work Hard support. So finding out what they're doing behind that would be amazing, amazing. So maybe I can, call on Boost Capital to help us, a non-profit organisation too.
You can even call on those researchers.
Here,
you have Corina here.
Delighted,
so I'm counting next event on happening here.
Absolutely.
To have the results of a research by ECU and the University of Liverpool.
Street. That would be wonderful.
Perfect. I know how data is important. I know. If I have learned something from the year you spent with us, this is the main outcome. Okay, so my last question before I open it up to you, to the audience, both here and online. So what do you see the opportunities and challenges in digitizing financial service provision and capacity building to entrepreneurs? We touched a bit about it, but what is your final word on the opportunities and challenges?
I think I'll begin with the challenges. And I think sort of it's the scaling up. So I've said we've got 24,000 members. In the UK, there's less than 2 million members. Scaling up that, and sort of everyone says credit is like the best kept secret. To scale up, the impact we'd have in the UK would be phenomenal, and so certainly that would be a big sort of challenge for me. How we do it, we rely on the likes of the younger people to help us, with that digitalization, and everything. But I don't think we'd ever forget our values either as credit unions. I think sort of, I was thinking about the Credit Union Act, within our rules, the first thing it says is promoting thrift amongst your members, and that's sort of, encouraging them, sort of not to overspend, not to get over indebted, small savings. It's just getting the message out there, to be honest. I'd love to. So that's my challenge. But the opportunities sat in these rooms, it's sort of, young students joining us, and coming into professional lives after they leave uni, they're the future of credit unions. So there's another invitation to you all. So enterprisecreditunions.org.
Very enterprising. So Porhour, what do you see the challenges and opportunities of digitizing both financial services and the capacity building to entrepreneurs or to clients?
So I think I'll start with the opportunity and then link to the challenge. So in terms of the opportunity, right, through our research, the short project that we were doing with Strive, we also found out that the customer who consume financial education but then got rejected for a loan, they were not rejected because of their inability to repay back the loan. Like it's mainly because they don't have the necessary document to apply for the loan that is required by the bank. So for example, if the person has a full-time salary, so like they are government worker with a full-time salary, but then also have like a side income where they run a grocery store, then only their main income from the factory, from the garment factory, can be counted as their income, but not their side business, which is a micro business that also produce a reliable income, right? So there's definitely an opportunity to use financial education as a substitution for certain document like that, or maybe just an incentive for the bank to look at these customers and say, okay, they have willingness to repay back the loan. Can we then take a look deeper at their other income that may not be something we previously consider as a worthy income, right? Because generally, especially here in Cambodia, there's a lot of micro businesses, but they don't have proper financial documents. So then the bank generally don't want to spend the time to assess the loan because it's not good for profitability. So we can use financial education as a proof or as a indicator that these customers are actually good customer. They have willingness to pay, and then we spend a bit more time in looking at their ability to pay and other income that we previously dismissed. So I think that's a good opportunity to look at. It definitely will expand the access to finance. But then comes the challenge, right? Because from the perspective of the bank or financial service provider, especially in the context of loan, they definitely don't want their NPL or their default rate to give up or to go up. So the risk is too big for them to take on if there's no data to prove them that these are a good customer. And the project that we've been running is rather small, and we definitely hope to continue on doing it, but we understand the limitation that the data we provide to the financial service as well. So one creative solution to actually de-risk for the banks, so then they can consider these customers who don't have like proof of income for their side business, is to do guarantorship, which is something we have also done previously with PAC through USAID fund. So the bank will take on 50% risk, and the donor, generally that's an organization, will take on another 50% risk, so that the bank is held accountable, but it also have them to de-risk their portfolio as well. So then they can, they are incentivized to expand their access or design product to this segment that is otherwise excluded from the financial service.
Thank you very much to both of you for your answers. So the floor is yours. If you have a question for Karen or for Porhour. Andrea.
Yes, thank you very much to both Porhour and Karen. My question, perhaps more relevant for Karen. I wanted to understand better how the credit union interacts with the wider financial ecosystem. Whether it is fair to say that the credit union operates in their own area and it's pretty much isolated from the remaining banking system, or actually it's the opposite. So yes, it provides the service locally, the memberships and the cooperative, but then there is a very strong link to the rest of the financial and banking system. If you could say something about it, and perhaps also in the same vein, with capital.
Thank you, Andrea. I think that's a great question. So we do work with banks. I think banks, it was touched on earlier about sort of, they all have CSRs, they all have that corporate social responsibility. They're trying to work under consumer duty now, making sure they're fairer to their customers and so on and so forth. And banks are coming to us as credit unions and asking us, like, sort of, how can we work together? So just sort of to give you an example, we're part of a pilot with the Lloyds Banking Group here in Merseyside. So customers, they can't help, right? They refer onto the credit union on a digital onboarding platform, and then they're referred over to us as credit unions. And that could be not so much because they got bad credit, but what I touched on, you know, you could have thin credit files, or it's just not like financially viable for them as a bank to offer someone a £400 loan. So we're working with Lloyds Bank. There's other banking groups that have invested in the credit union sector over the years. You know, so we all work with the banks in some capacity. You know, we have an all parliamentary party group, including like sort of many of the CEOs in the big banks. So we're at the table, you know, and so we are speaking to them. And I think in some cases, and I'll be honest, some banks see us as like the poor relations, if you like, you know, and sort of like a tap on the head. But I think when we can get our story across, you know, say this is it, then, you know, it's wonderful, you know. So I've gone to Lloyds Bank personally and said, we want a building in Liverpool. Have you got any? You know, so I'm hoping that they're going to come back and say, yes, you are, we're closing this branch, you can have this. But I live in hope. But certainly across the country and across the world as well, you know, so that banks are listening to credit unions. And we're not silly. We know that people need banks for the day-to-day living and so on and so forth, you know. And so if our members don't want to bank with us, they use the bank, and that's fine. You know, I don't sort of think we're isolated in such a way. I just think we've got a bigger voice now than we ever have. So, you know, I'm delighted to see, and let's hope that expands as we move on. I hope that answered your question.
Porhour, you want to take the question as well, in how integrated is Boost Capital in the financial sector in Cambodia or in the countries that you are working in?
Yes, so we work closely with the Credit Bureau Cambodia. We also working with a lot of banks here in Cambodia as well, to mainly do financial service onboarding. With AFK, we're actually one of the leading microfinance here in Cambodia. We're actually doing another financial education project, but this time not looking at financial education consumption in relation to loan, but financial education consumption to ability to save. So this time around, we are integrating financial education to saving onboarding customer instead, and start to look at whether these are the population that would generally save more or have more transaction with the bank, but also have like leftover money in their bank account. So that's what we are doing as well.
So your integration and your link to the financial sector, because you are a service provider to MFIs and to banks, is happening through your clients, right?
Yes.
Okay, thank you.
So obviously interest rates have been going up and up the last year or two, and you're trying to provide the best service you can to your customers. So how do you manage that, like with the interest rates going up, and how do your interest rates compare on your loans to like the high street bank?
Okay, so you're right. You know, the interest rates on savings have gone through the roof. You know, so that as a cooperative, we offer our members a dividend, and that's a big challenge. So that a return on their savings. We have never increased our interest rates on our lending, and you know, certainly in the business plan, we don't intend to. you asked all the interest rate. So compared to a bank, it depends on the value, but compared to the bank, I'd probably say we're one of the best competitors out there. So we was all, it's 1% a month on reducing balance. In real terms, that would be £1,000 loan will cost you £63 interest over a year. You know, and so that's the way we work, and those rates do come down. But it's a delicate balance when the banks are offering high interest rates. But you know, people don't realise we rely on savings to maintain those loans going on. And if people are taking savings out and going to a bank for a higher return, then obviously, you know, we're stuck to, you know, with that loan capital to try and keep that going. And with the dividend as well, you know, proud to say that we've done like return on our savings for the last 11 years now, you know, with at least a 1.5% return. Last year it was 3.5%. So, but not all credit unions can achieve that. So it is very, you know, sort of difficult to maintain your sustainability while providing a return for your savers as well. You know, but we have to be compared to, you know, the doorstep lenders of this world, you know, payday lenders. You know, they offer, CDFIs offer interest rates of over 100%, whereas credit unions can't go any higher than 46%. So, you know, that is, it's a selling point, but it's got its like its downfall, because obviously we need to sustain ourselves as well.
Hi, my name is James Hickson. I'm a researcher here at the Yousra Institute for Public Policy here at the University of Liverpool. Another question for Karen. I'd be really interested to know if you're seeing the impact of an increasingly insecure or precarious labour market on the kinds of clients that are coming to you, and whether that's having a tangible impact both on their credit score but also on their need for access to credit to kind of fill those gaps in a you know, increasingly sort of volatile incomes. Is there a space for credit unions to be providing a sort of insurance for unemployment or gaps in employment, or even sick pay where those rates aren't accessible?
I would love to say that credit unions could be the holy grail, you know, to everyone's issues. Unfortunately, that's not the case. However, I think what you're saying there about volatile lifestyles, you know, you're seeing people now, not just so much people who are in and out of work, even people who are in on a low income, you know, but they're struggling to meet ends meet. Are we seeing an increase in that? 100%. We're seeing that, you know, more and more people. And that's what's the beauty of where they built up savings over the years. Take a couple of pounds out or whatever, I'm going to say a couple of bob then, but you know, some money out of their savings to maintain that sort of these shock points they're in now, you know, but we believe they're not going to be like that forever. Do you know what I mean? So it's like, we will still work with them, we will still, but regarding often unemployment or insurance, as far as I'm concerned, that's the government's job, not ours. Do you know what I mean? So I hope that answered it. I hope it didn't get too political.
Good morning as well. Thank you for the image. So I have a question to Paul. Paul, you mentioned the consumption for the customer in the micro MFI.
Financial cooperative?
Yes, in microfinance institution. So I had a chat. It's interesting because you mentioned it. I had a chat with someone from central bank in this developing country, and it was saying that actually maybe the consumption and the utility that it's used in mathematics may have to be thought differently. I don't know if you think that there is a different pattern that you observe, some pattern different to what is normally observed in general in that case for those customers.
A pattern and a difference between what and what?
Because, when you have consumption, when you have she mentioned, I think they were looking at consumption. Am I correct? Was it correct? Did I understand correctly, Paul?
You are talking to Porhour.
Yes.
Okay, yes. The consumption, they were looking at consumption of financial education, not consumption as a pattern. When she mentions consumption, she means the consumption of the training, using of the training, where they connect to the platform and they take a mini training. Right? Is that right, Porhour?
Yes, financial education consumption.
Okay. That's
Any other questions from the audience?
Lisa.
Are we allowed to ask questions? Okay, so this is Lisa from the ILO. Yeah, so I have two questions for you, Karen. Thank you both for really interesting presentations. So you mentioned insurance, which is one of the areas that I focus on, and that you've dabbled a little bit in insurance. So I'm curious to know, like, how long have you been looking at insurance as part of your services, and what has your experience been? So that's my first question. The second question is that I would say, and you can disagree with me if you want, I would say in the UK, there's more of a debt culture than a savings culture. I mean, having lived here a while ago for 16 years, like there was lots of opportunity for banks to keep like pushing loans on you, even when you didn't need it, buy this, take credit. So I would say in my experience, it seems to be more of a debt culture than than a savings culture, and people wanting to spend. Is that something that you try and change with your members in terms of their behavior when you give them education, or is it something that you kind of give up on because it's in the culture around you? Thank you.
Okay, thank you. So the first question regarding the insurance. So every member in the credit union has life insurance against any savings and loan protection in case they die. The credit union pays that sort of through any surplus that they make. We've just gone into member pay products. So we're offering at the moment life insurance for £80 per year. Well, it's £6.70 a month. An individual can insure themselves for up to £5,000 for in the case of death. And that is because of the funeral poverty we see. You know, so many times we see people coming in asking for loans to bury their loved ones and so on and so forth. So I'd love, in Ireland, they just launched something called the People's Insurance, and that is a suite of products. Again, very low cost, like sort of, the payment is set to suit the individual, and that includes holiday insurance, house insurance, and car insurance. So over here, through legislation, we haven't been able to get there yet. But I'm very positive that by the end of this year, we will be extending that out to offer the whole suite of services for all of our members.
And what drives that?
So we have a company called C Mutuals, CUNA Mutual, the Credit Union National Association. It's an insurance company for credit unions, if you like. That again is a cooperative. And so that works. That's a worldwide organisation, and they also have a base in Ireland and the UK as well. So we are very hopeful on that. We also have like a group policy as well, where say the matriarch could insure, a husband and a mother and so on and so forth within a family plan as well. So that works. And the reason I'd love holiday insurance and car insurance and so on and so forth. A lot of our members wouldn't be, sort of having cars and stuff. A lot of them are financially excluded. Brings me back on to that question you said about the debt culture. And I won't be political, but I mean, it certainly hasn't only been the last 16 years. And that I was brought up like that, I was brought up, and that's how I got involved in credit unions, where I was brought up in financially excluded household, if you like, and then growing up, I left school, got a job. And the first thing, was all kinds of letters come through the door saying, do you want a credit card? I mean, who's going to say no? Yeah, well, I'll go on holiday with my mates and so on and so forth. So absolutely, but I think that come from previous governments again. But I think that's been generational, certainly in Merseyside, that culture, because their family haven't had access to build up those savings over the years. Going back to credit unions, 100%, and certainly in my credit union, it's not to keep people in debt. There's nothing better than working with someone who even like sort of a couple of years and they've got more savings and they go, actually, I don't need any lending now. I'll just take my savings out. We've done our job, and so I'd love that, to expand and expand and expand, because there'll always be someone else, with a different pair of shoes on who will need access to that credit in that short period, but building up those savings and that strength with you, there's no better feeling than someone coming in and saying, Karen or whoever, I'm going to take my savings out. It just there's no better feeling. So
brilliant. And I also wonder, just from a behavioral economics point of view, maybe this is somewhere where the academics can come in. If there is certain timing and messaging, if you can quantify when it's good to have certain messages to your clients, that would have the most impact statistically. And I don't know if that's something you've delved into, but maybe it's an idea for researchers.
I don't quite understand the question, but if
behavioral economics says that if
to try and change behavior, you can have certain interventions. So I think at the London School of Economics, there's a behavioral insights team, but maybe that's something that mathematicians can also get involved in, is when you have certain messages at certain times to your members about savings and credit, when will those messages and which messages have the best impact to make them behave in a certain way that will make them take less debt and save more?
I think so that you don't have a seasonal message per se, so it's just a constant message and say, build up your savings, you don't need to borrow that much, look at what you're sort of borrowing for, and having that constant message. I hope that answers your question, but certainly it's having that relationship and sort of saying, well, don't borrow. You can't say to a young mum with 2 kids, you don't need to borrow. So if they do, and just working with them, but also getting that message out saying, while you're borrowing, try and build up a couple of pounds in your savings. You're not always going to be like this. So that works.
Thank you. Okay, last question.
Thank you. So I'm Francisco Rowe, Professor of Population Data Science here at the University of Liverpool, from geography. So I was wondering, I don't know if I got late here, so excuse me if it was covered already, but thinking of blockchain technology, so could you give us a bit of a sense to what extent that has been integrated into the financial system here in the UK? And also, I guess, a bit of because the idea, right, of blockchain technology is that probably it's going to provide access to people that don't have access to the financial system. So the whole idea is based on a decentralized financial system, right? So that is kind of disattached from the banks. So could you give us a bit of a sense of what banks are doing in relation to that, and to what extent that has been integrated into the financial system today?
I think COVID, sort of determines the way banks and credit unions and everyone, sort of use digital, so certainly from our point of view on banks, I think we're trying to get more digital, but it's, I say to all my team, absolutely, I want the journey for a member to be so slick, you can apply for a loan at 3 o'clock in the morning or a savings account, so on and so forth, but not everyone wants to take that up, so it's just trying to find that balance. And the banks are challenge as well. And so they want like the Mondo effect. I'd say, Mondo's a challenger bank, but someone can go on, and send money, to Singapore within seconds and so on and so forth and all of that. Whereas, credit unions are not there yet. But I think COVID, like sort of made us think differently, and sort of try and get more of a digital offering out there with that choice. That if they want to speak to someone or call in, and they can. I hope that answers your question. Yeah.
Okay, so thank you very much for your questions, and thank you so much to Karen and to Porhour. So please join me